You know that saying, the quietness precedes the storm? We usually think about weather, right? But what if that same idea, that quiet calm, actually holds a really powerful, usable truth right in the stock market? Today, we're going to dive deep into exactly that, how these periods of, well, really low volatility, the times that frankly seem a bit boring, can actually be the setup for some of the most explosive moves in stocks. Think of this as your inside track to understanding what might be coming next.
Yeah, it's absolutely true. It's not just some nice saying. It's something you can actually see, a signature of what's happening under the surface in the market dynamics. And it's something legendary traders, guys like Mark Minervini, Dan Zanger, have studied and used for years. They turn that apparent market boredom into, well, a predictive edge.
Right, so our goal today for you listening is to give you the tools to spot these quiet periods, these consolidations, and understand what they mean. Getting this can give you a real strategic advantage, setting you up for trades with, a much better risk to reward potential. We're basing this on solid research, expert reports, and the actual methods these top traders use. It's kind of a shortcut to grasping these powerful market ideas.
Okay, so let's unpack this a bit. When we say quietness in the market, what are we actually seeing on a chart? And why should we care? Why is it important?
Well, that quietness is what we call consolidation. It's simply a time when a stock's price trades in a pretty narrow range, back and forth. It signals that the market's kind of undecided for a bit. Buyers and sellers are basically in balance temporarily. Think of it like the market just taking a breath, and this listless price action, often with really low trading volume, that's your key visual cue. Something's brewing, but it's happening quietly. I like that, taking a breath. But okay, what's actually going on during that quiet time? How does that set up these huge moves later? Is it just random? Or are big players involved?
Oh, it's definitely not random. It's all about spotting the footprints of institutions.
Hmm.
See, for the big players, the hedge funds, mutual funds, the smart money, these quiet consolidation periods are golden opportunities. Strategic windows. They use this calm to buy or sometimes sell huge amounts of stock without drastically moving the price against themselves. Imagine trying to buy millions of shares when a stock's rocketing up, you just push the price higher and higher.
Right, makes sense.
So during consolidation, they can accumulate methodically. They buy shares, often over weeks or months, absorbing the supply from, let's call them weak hands. Those are maybe impatient retail folks or people selling out of fear. And these shares get transferred to strong hands, the committed institutional buyers. When you see a stock forming a solid base, refusing to fall lower despite tests, that's often accumulation. Now, the opposite is distribution, where they're quietly selling off their shares. So for you, the main job is figuring out which one is happening. Are they buying or selling? You read the footprints.
It sounds like they're masters of moving huge sums without making waves.
Mm.
So if we're watching a chart, what's the first real clue that this quiet buying is about to explode into a visible price move?
The absolute key element, the number one thing, is the absorption of available supply. As those shares move from the weak hands to the strong hands, the amount of stock actually available for sale just dwindles. It dries up. Mark Minervini calls this the line of least resistance. It gets to a point where supply is so scarce that even a little bit of new demand can trigger a really fast, explosive move upwards. There's just nothing holding it back.
Ah, okay.
You might also see things called shakeouts during these times. These are quick, sharp drops in price within the base. They're often designed to hit the stop losses of retail traders, shake them out, allowing the big players to scoop up even more shares at better prices. It can seem that way, but if the price recovers quickly after a shakeout, that's a huge sign of strength. It shows the smart money is soaking up everything thrown at it. It's about reading the intent. Are the sellers exhausted?
Okay, so these hidden moves, the shakeouts, the slow buying,
Hmm.
how do we get confirmation that it's real accumulation and not just, the market going nowhere? Is there one indicator that really nails it?
Absolutely. The confirmation comes from volume analysis. This is critical. During real accumulation, as that price range gets tighter and tighter, you must see trading volume contract. It should noticeably dry up. This confirms selling pressure is just fading away, fewer shares are being offered.
Right.
Then, crucially, on the breakout itself, when the price finally pushes above that consolidation range, you need to see a dramatic surge in volume. We're talking maybe 40, 50% or even more above the recent average volume.
Okay, that's specific.
It's essential. That volume surge confirms that demand has finally, definitively overwhelmed the remaining supply. It's the institutional footprint becoming obvious. A breakout on low volume, that's a major red flag. It suggests the big players aren't really behind the move and it's much more likely to fail. And generally, the longer and tighter the consolidation, the more supply has likely been absorbed, and potentially the more powerful the eventual breakout. A 6-month base usually packs more punch than a 6-week one.
Okay, this is starting to form a clearer picture. We understand the mechanics now. Let's get into the actual patterns traders look for. First up, the volatility contraction pattern, the VCP. That's Mark Minervini's signature, right?
Exactly. The VCP is, well, it's a brilliant way to quantify the supply absorption process. It typically forms during what we call a stage 2 uptrend. That's after a stock has already broken out of a major base and is in a healthy advance. The whole point of the VCP is to pinpoint the optimal, lowest risk spot to jump in. Visually, the core idea is seeing volatility. Well, contract. You'll see a series of pullbacks in price, but each pullback from the high is shallower than the last one. As you look from left to right on the chart, the swings get tighter and tighter. It's a visual demonstration that sellers are losing steam, they're being absorbed.
So it tightens up over time.
Precisely. A typical VCP might have, say, 2 to 6 of these distinct pullbacks or contractions. Minervini calls them TS. Usually, the setups with 2 to 4 Ts are considered higher probability. So, for instance, the first dip might be 25% off the high. The next one might only be 15%, and maybe the final little whittle before it breaks out is just 8% or even less.
Wow.
It quantifies that seller exhaustion. Minervini even has this shorthand, the VCP footprint, like 19W1974T. That tells you it formed over 19 weeks. The pullbacks tightened from 19% down to 7%, and there were 4 contractions. It makes it objective, repeatable.
That's incredibly systematic. It takes away some of the guesswork. Now, how does volume play into this specific VCP structure? Does it follow the same rules drying up than surging?
Yes, exactly the same rules, but even more critical within the VCP structure. The volume has to confirm the price action. As those price swings get tighter with each T, the trading volume should also shrink significantly. It needs to dry up. Especially look for low volume on the down days within those contractions. That's your confirmation that supply is becoming really scarce.
Okay.
Ideally, right before the breakout, in the last few days of that final, tightest contraction that's called the pivot point volume should be at its lowest levels for the whole pattern. And then, the breakout must happen on a big volume surge. Like we said, 30, 40% or more above the average volume is a good benchmark.
That's the green light.
That's the green light. It shows demand has finally swamped supply. Institutions are pushing it. That pivot point, that specific resistance level at the end of the tightest T, that's your ideal entry. And the beauty is this structure lets you set a very tight stop loss, maybe just 5–8% below your entry, so your risk is clearly defined and relatively small compared to the potential reward aiming for that 3.1 ratio or better. It's inherently asymmetric.
Getting in right at that point of least resistance, as you said. Okay, theory is great, but let's make this real. Can you walk us through some actual examples where VCPs led to big moves?
Oh, absolutely. We've seen countless examples in market leaders. Think back to Tesla, TSLA, in 2020. It had that incredible 600% run-up. Then it paused, formed a 3-month VCP. The pullbacks went something like 25%, then 20%, then tightened to just 10%. Volume dried up beautifully. What happened next? Another 90% advance.
Wow.
Or Shopify, SHOP, back in 2016 after its IPO run. It built this picture-perfect VCP. The final contraction was super tight, only 5% deep as volume just vanished. The subsequent breakout led to almost a 200% surge.
Textbook.
More recently, NVDA in 2023 showed classic VCP traits, those tightening pullbacks, contracting volume right before launching a major new leg up in its uptrend. And it's fractal, meaning it works on smaller time frames too. We saw an intraday example in Riesh. It formed a tight little VCP on, say, a 5-minute chart. You could see supply being absorbed at resistance, then boom, a 13% plus breakout in less than 2 hours once demand kicked in.
So these aren't just random shapes. They're like stories told in price and volume.
Exactly. Quantifiable narratives of supply versus demand.
Okay, the VCP is clearly very precise. But you mentioned other legends like Dan Zanger, William O'Neill. They identify classic patterns too, reflecting similar ideas, right? Let's touch on a couple more.
Definitely. While VCP is a powerful framework, there are other well-known consolidation patterns. A big one is the flat base. This is a classic pattern you often see after a stock has already made a significant move, say 20% or more up from a previous base. It's a second stage base. The key thing here is its shallowness. The correction from the high to the low within the base is usually 15% or less. It needs to last at least 5 weeks, often 7 or more. And the price action should look tight, orderly. It's quiet accumulation, the trade. Buy the breakout above the high of that base, again, confirmed by that big volume spike.
So shallower and longer than maybe some other patterns.
Generally, yes. Then you have bull flags and pennants. These are much shorter term patterns. Think of them as quick pauses, continuation patterns during a really strong, fast uptrend. You first get a sharp, almost vertical price run-up on heavy volume, that's the flagpole. Then the stock consolidates briefly, maybe for just 1 to 4 weeks. A bull flag looks like a small rectangle sloping slightly down. A pennant looks like a small symmetrical triangle with converging trend lines.
Okay, I can picture those.
The volume pattern is key. Heavy on the flagpole. Then it really recedes during the flag or pennant formation, and then spikes again on the breakout above the upper trend line. Entry is above that upper line, stop goes below the lower line. Often, traders target a move equal to the length of the original flagpole.
It's fascinating. VCP, flat base, bull flag. They look different on the chart, different durations, different depths. But it sounds like they're all fundamentally telling the same story, just in slightly different ways.
Yeah.
How did traders like Minervini and Zenger converge on this same core idea?
That's exactly right. They are all just different visual manifestations of the exact same underlying market dynamic. Supply being absorbed by strong, committed buyers. You might see them at different points in a stock's journey. A big VCP breakout from a primary base, then maybe a flat base forms later, and within that, you could even spot a little bull flag on a shorter time frame. The VCP framework, actually, with its focus on tightening volatility, can even be used to analyze the internal structure of a flat base or the consolidation part of flag. What really unifies these approaches is that objective look at price and volume, searching for that specific point where sellers are exhausted. You can almost create a checklist, like a comparative table looking at context, duration, depth, structure, volume, entry. It helps you classify what you're seeing and apply the right rules.
Okay, spotting the pattern is step one. But turning that analysis into an actual profitable trade, well, that takes discipline, right?
Yeah.
So practically speaking, once you've identified a solid setup, how do you actually execute? What are the entry tactics?
Right, execution is where the rubber meets the road. Generally, you've got 2 main ways to enter once you see a valid setup starting to break out. First is buying the breakout itself. As the price clears that pivot point or resistance level with authority, you jump in. The pro is you're immediately moving with momentum, capturing the move right from the start.
Get in right away.
Or exactly, the con. You might be paying a slightly higher price, a premium, and you're more vulnerable if it turns out to be a false breakout, a head fake. The second option is buying the pullback, sometimes called the break and retest. Here, you wait for the initial breakout, then see if the price pulls back to touch that former resistance level, which should now act as support.
A bit more patience required.
Yes. The pro is you get confirmation the breakout is holding, often a better entry price, and potentially a tighter risk-reward setup. The con. Sometimes the strongest moves just blast off and never give you that pullback, so you might miss the trade entirely.
So it depends on your style, your risk tolerance.
Exactly. No single right answer. Depends on the trader.
Okay, that makes sense. But this brings up a crucial point. Even with the best setups, trades don't always work. What happens then? How do you protect yourself?
This is probably the most important part. You must use a non-negotiable stop loss. It's the absolute foundation for staying in the game long term. Your analysis of the pattern tells you exactly where the setup is invalidated. For VCPs and flat bases, if the price drops back below the low of that final tight consolidation area, the accumulation premise is broken. That's where your stop goes, just below that low.
Clear invalidation point.
For flags and pennants, it's usually placed just below the lower trend line of the pattern. If it breaks below that, the pattern has failed. You mentioned Dan Zenger earlier. He's famous for a strict 8% rule. If a stock drops 8% from his purchase price, he's out, period. No questions asked.
Wow, that's discipline.
It's pure capital preservation. Your stop loss isn't just a suggestion. It's your eject button when the thesis is proven wrong. You have to honor it.
So, entry point identified, non-negotiable stop loss set. What about how much money to actually risk on the trade? How do you decide the position size?
Position sizing is huge. Honestly, it's probably more important for your long-term results than picking the absolute perfect stock. It's all about managing risk. Mark Minervini is a big advocate for risking only a small percentage of your total trading capital on any single trade, typically 1% to maybe 2%.
Only 1 to 2%.
Of your entire trading capital. So let's say you have $100,000. You'd risk no more than $1,000 to $2,000 on one trade idea. Now, how do you calculate the actual number of shares? It's based on the distance between your entry price and your stop loss price. If your stop loss is tighter, say only 5% below your entry, you can buy more shares compared to a situation where your stop is 10% away, while still keeping that total dollar risk, the $1,000 or $2,000, the same.
So the tight stops allow bigger positions for the same risk.
Exactly. That's why these tight consolidation patterns are so powerful. They allow you to magnify your gains on winning trades because you can take a larger position size relative to your risk. The goal is always to find setups with that asymmetric reward to risk. You want trades where your potential profit is ideally 3 times or more than your predefined risk. That mathematical edge is key over the long run.
Okay, that risk management side is clearly crucial. But, reality check time. Not every quiet period ends in a storm. Sometimes it just stays quiet. Or, worse, the breakout fails. What happens then? And can we spot those failures coming?
You're absolutely right. No setup is foolproof. When a breakout fails, it's often called a bull trap. What happens is the price breaks above resistance, sucking in buyers who think it's go time, their buy orders get triggered, but then, the price quickly reverses and falls back below that breakout level. All those recent buyers are now trapped in losing positions.
Ouch.
Yeah, and as they scramble to sell and cut their losses, it actually adds selling pressure and accelerates the reversal downwards.
So, aside from just hitting our stop loss after the fact, are there warning signs before or during the breakout attempt that might signal, hey, this quiet period might be a dud?
Yes, definitely. There are several red flags to watch for. The number one most significant warning sign is that lack of volume confirmation we talked about. If a stock breaks out, but the volume is just average or low or even declining, huge red flag. It screams lack of institutional conviction. A real breakout needs that power surge of volume. A quiet breakout is suspicious.
Got it. Volume first. What else?
Look at the price action within the base. Is it tight and orderly, or is it wide, loose, choppy, erratic? A messy consolidation often leads to a messy failed breakout. It signals instability. Also, consider the overall market context. Are you trying to play breakouts when the general market is clearly trending down? In a bear market, that's a low probability game. Tailwinds help.
Right, don't fight the tape.
Exactly. And finally, be aware of external factors. Unfavorable news about the company or sudden negative shifts in the economy or interest rates, these can kill a perfectly good technical setup overnight.
It's really interesting. These failures aren't just random noise. There often seems to be a psychological element at play, almost like the market exploiting human emotions.
Oh, absolutely. Failed breakouts are masters at playing on greed and FOMO, the fear of missing out. When a stock starts to pop after being quiet, especially one that people have been watching, the urge to chase it can be intense.
Yeah, you don't want to miss the move.
Right. So less experienced traders might jump in late, often placing their stop-loss orders just below that breakout level, thinking it's now support. This creates a predictable cluster of stop orders, a pool of liquidity. Sophisticated traders, or algorithms, might actually target this level. They can push the price back below the breakout point just enough to trigger those stops.
Forcing those late buyers to sell.
Exactly. Forcing them to sell, allowing the bigger players to absorb those shares, potentially before moving the price in the opposite direction, or just clearing the decks. In fact, a failed breakout can sometimes be a very powerful signal in itself, but for the short side. If a breakout fails miserably, it might reveal that what looked like accumulation was actually distribution. It could signal a high probability opportunity to bet on the price going down. It's all about reading the evidence objectively.
Wow. So even failures tell a story. Okay, as we start to wrap up this deep dive, what's the big takeaway here? If you had to distill it down for our listeners, what's the core message?
I think the core message is that this principle, quietness precedes the storm, isn't just folklore. It's a really robust, timeless concept in the markets. The methods of traders like Minervini, Zanger, O'Neill, they're all connected by this central idea. Identify where institutions are quietly accumulating shares during these consolidation periods, and then find that precise point of least resistance to enter, just as demand is about to overwhelm supply. That high probability setup really boils down to a checklist. Is the stock in a confirmed stage 2 uptrend? Is the overall market healthy? Is a consolidation clean and tight? And critically, does it have that clear volume signature drying up in the base, surging on the breakout?
Right, and connecting that to the bigger picture, you can have the best pattern recognition in the world, but without discipline.
Exactly. Long-term success, what some call super performance, really hinges on unwavering discipline. The analysis, the patterns, they give you the map, they show you where the potential opportunities are, but it's discipline that fuels the engine. Discipline to follow your rules, to manage your risk meticulously with position sizing, and crucially to cut your losses without hesitation the second the trade proves you wrong. That's what separates consistent winners from the rest.
So maybe a final thought for you, the listener, to chew on. How much more might we understand about where the market is headed if we spent less time chasing the noisy headlines and more time listening to these quiet underlying conversations between buyers and sellers, anticipating the next storm or the next calm before it becomes obvious to everyone else?